Recently, you may have heard some news about a new compliance rule from the NFA that effectively prevents Forex traders from hedging. Hedging might be defined as having a long and short position both open on the same currency pair at the same time. I'm sure there are some legitimate reasons why the NFA has chosen to make hedging not possible in the Forex spot market, although hedging has always been a legitimate trading technique used by banks and large institutions to offset risk. One possible reason might be that if in the retail Forex market many brokers are actually hedging the position of their customers, that is, automatically assuming the opposing position. And this doesn't mean trading against the customers, and that's something that we'll talk about more in greater detail in another video. But if the retail Forex brokers are assuming the opposing position of their customers, then if the customer is also entering a position both long and short at the same time, and then the broker also is entering a position long and short at the same time, it would kind of make things difficult, I guess. And I don't really understand how all that works, but I have some experts from the Forex broker industry who are going to come and help to explain how this works to the Forex trading community. Now, hedging by itself is not necessarily a productive thing for a Forex trader to do, because as soon as you enter a trade in both directions, it's the same as if you're not trading. So what's the point? And in this discussion, we're not talking about entering two trades in opposite direction specifically for gaining the difference in interest, although for some people that may be a legitimate investment strategy. For me as a trader, the purpose of trading is to enter a trade and to get the profit on the trade. Now, if you look at this chart of the pound versus the yen, this is the daily time frame, and we could say that from around January the 25th, this pair has been going up. Now, if we were in a long-term trade, and this would apply to any time frame, by the way, we might be trading this entire move in one trade. On a shorter time frame, these moves down might also be legitimate trades that we might want to enter in the opposite direction on a different time frame at the same time, and that's a very legitimate trading strategy, I believe. Because our trading method identifies trades on all time frames, we often have the opportunity to enter trades on different time frames, some in the same direction and some in the opposite direction. We have also found that by studying the strength and weakness of all the currencies against each other, we can make even better trading decisions and will never need to hedge on the same currency pair. For instance, you may know that a lot of the currency pairs are closely correlated with each other. That is, they make very similar patterns and often move in the same direction. Take, for instance, if you were going to trade the pound versus the yen. You might also watch the euro versus the yen on the same time frame and see that it's been doing a very similar thing, not exactly the same. So just for instance, if you take these two pairs, the pound versus the yen and the euro versus the yen,